Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for our Thursday edition of Trader Talk in today's market. I'm your host, Kevin Horner. It's a bright morning, sunny morning here in Denver, Colorado. And today we are looking at a market that did not want to stick the brief market bounce we got yesterday or late on Tuesday into Wednesday. We're going to talk about what we did yesterday, how we found some levels that may have acted as some resistance, and of course, we're going to talk about the rise in oil this morning, which is pretty darn notable and absolutely pressuring stocks. So this morning, I am running solo for you, but of course, I am very pleased to be joined by my friend and Schwab coach, Barb Armstrong, there in the chat. Say hey to Barb. She'll monitor and manage comments and questions that I'm unable to get to for you, but I'm going to keep an eye on things nonetheless, so feel free to post in there for the duration of our show. Reminder that tomorrow is considered Good Friday. Of course, that's on the holidays calendar. On Good Friday, the market is closed, and so will the coaching team, at least in terms of hosting. So market will be closed. Schwab YouTube channel will not have live content tomorrow. And of course, we'll look to reconvene with you on Monday. So with that, let's try to wrap up the week here as best we can. We'll take a look at a boatload of charts as we like to do, particularly on Thursdays. And we're going to try and kind of ascertain what levels we might need to be looking for. Where could we get bounces? Where can we hold support to kind of set the table for next week? So with that, I'll remind you to follow Barb and me on X, Barb Armstrong CS, Kevin Horner CS, and of course, make sure you're subscribed to the YouTube channel that we call Trader Talks. Now, let's get to our disclosures and then we'll jump to the chart. So first of all, remember that everything we discuss today for you is considered informational and educational only. We do not make recommendations nor endorsements for any specific approach to trading the market here. We will utilize technical analysis as we evaluate these areas of the market, though. With that in mind, remember that technical analysis is just one of your decision-making points, not the only decision-making point, and we encourage you to base decisions off a multitude of factors rather than just one thing. Now, our agenda will remain largely the same. We'll start with our top-down approach. We're going to expand a little bit, though, beyond just the indices, of course. We're going to look at relative strength. I've got the relative strength charts to look through. We're going to, of course, check on the quotes for the day relative to how things are looking on a year-to-date basis, where are our opportunities, etc. And then we'll work our way through industry groups, sectors, and stocks in the news. Got some upgrades and some downgrades to make sure we hit on for you today. All right, so with that, let's jump to those charts. We'll take a look at the S&P, and my goodness, I'll tell you, yesterday, we really did cover it, everybody. We talked about the 20-day moving average providing potential resistance for us. And boy, we didn't even get to touch it, did we? Yesterday, the 20-day moving average kind of finished the day at that 66.20, and our high yesterday was 66.09, almost 66.10. And that candle certainly didn't feel great at the close of the day. We were looking for a candle kind of reminiscent of this one from 2 days ago. Or if you look back at when we made this we started really falling here, we had this beautiful hammer candle that we followed through and gave a day where we finished close to the 20-day, and yet we still have continued downtrend. And so again, the reminder from a technical analysis basis, everybody, is the trend that is working right now is more apt to continue than to break. With this in mind, and again, it's all about probabilities, not certainties. The probability is that the trend remains in play. And so yesterday, as we talked about rallies into the 20-day, we talked about potentially taking some position off if you were playing this bounce. We loved the candle we got on Tuesday into Wednesday because it was a big, beautiful, long-range day with a close well above the high of our low day. And yet, it didn't stick. So we rally into the 20-day, fade in the last couple of hours of the session, and then today we've got a gap lower. Less than ideal, to say the least, because in reality, while we had a cold day on Tuesday, well, today is giving us a close below the low of the high day, and yesterday being our high day in the bounce. And so for you traders that are watching this short-term downtrend, today's action actually gives the bearish trader the opportunity to continue playing the downtrend. And so how does a bearish trader look at this? If they want to stay bearish relative to the S&P, they can do so based on today's gap move below the low from yesterday, and then more or less stay with their downside projections, their downside trend, unless and until we finally get the SPX to close back above that 20-day. Now, confirmation of that 20-day close back above the 20-day, whether that's 1 day, 2 days, 3 days in a row for the trader that says, all right, now that we've closed above the 20-day for those 3 consecutive sessions or more, something like that. Okay, everybody, you got to have that defined for yourself. That trader then decides to cover their shorts. But given the way that this has worked, there is very little reason to deny what we are seeing in the short run here, right? The short-term trend continuing this morning. Certainly, we're trying to verify and validate recent lows as the lowest we will see. What we don't want to see, of course, are lower lows. So stay vigilant. Make sure that your position sizes are proper for your tolerance for risk. Expect choppiness in the market, expect volatility, and that is more likely to continue now given what we have seen. Now, since we're looking at the S&P, of course, I want to remind us of why we're seeing the SPX move the way that it is. So I'm going to bring back the chart that I've been working with a lot for the last month for all of you, and that is the side-by-side of the futures in the S&P 500, the VIX, and oil. And I think it shows exactly what's going on here, everybody. We have on the far right the oil futures. These again are the light crude futures here, moving strongly to the upside. We popped through $100 a share and things took off. And again, this is the future symbols, everybody. We are not encouraging futures trading, of course. We're just utilizing this as an understanding of the trend. So keep in mind, the big thing here is we got through 100 and we popped 13%, everybody. I mean, that is a massive move in oil upward. So the uncertainty as it relates to oil continues to weigh heavily on our markets. Notice that the VIX popped back over 26 and looks to be kind of in a bullish pattern here, of course. Another aggressive move to the upside this morning, a brief throwback over the last hour, building a bit of a bull flag in the VIX. That's not great for the rest of the S&P, of course, because if the VIX is going to continue to climb, then the expectation is that the S&P may very well continue to struggle, and that's what we've seen thus far, right? So the higher oil goes, the stronger the inflationary likelihood continues. So we've got this market of questionability here, right? We've got higher oil leading to higher inflation, leading to fewer jobs, and this is all a tightening market, unfortunately. So it is absolutely imperative that we traders have a plan. And if you are out there saying, well, I've got a plan to just hold the course and stick with things, well, then you need to make sure that the levels you're watching are levels you can manage. Because if we take a look again at the S&P in terms of the long-term viewpoint, everybody, our prior highs are a very solid area for a potential zone of support, but it doesn't even have to hold there. So, I mean, I think a lot of traders are kind of looking at this 6,000 to 6,100 level as an area for short-term support, and we certainly could hold there, but there's nothing to say that we couldn't trade under 6,100. And I'll just point out, 6,100 is about 400 points away from where we are right now, 380 from where we are right now. And that's about a 5% move. It's not going to feel great if we get there, but I have to point out how frequently we fall through those areas of short-term support, right? So It's not to suggest that I know what's coming, because I really can't give you the future thanks to technical analysis. It doesn't tell us the future. It just helps us manage our risk. So if we're thinking about it, and we can sustain a move down to the white line in 6,100, then we can stay with the positions that we hold, right? If you can manage the move to 5 down to that 6,100 level and another 5% to the downside. The question becomes, what if that doesn't hold? And thereafter, what decisions do you make, right? Do you lighten up your most aggressive ones, your most risky ones? Do you maybe utilize that weakness as a means of buying defensive groups? Okay, these are things that can be considered. These are things that you can build into your own plan. And yesterday, one of those keys, as we'll look at with regard to sector, is that what was the sector that was beaten down over the last 2 days? It was energy, right? Energy was sold off as we got rallies in tech and communications and financials and industrials. Everything kind of popped yesterday and the day prior, and then energy sold down. Well, energy found support. And then today you're getting a bounce in energy because, well, why? And because oil's up 13%, not too much of a shock there, right? There's a clear relationship. So know your levels, know where you make changes, know where you stay comfortable, and know where that comfort changes. Okay, very big approach for us as traders. So, okay, we're going to look at the NASDAQ 100. Looks unfortunately quite similar. So I have a lot drawn in here, as you all know. We've talked extensively about the 20-day providing resistance in the NASDAQ 100. We've talked about the double top. This red line is the neckline of the double top. That double top line, the neckline, was violated and then became resistance. We were above it yesterday and then below it today. So we had what many traders with yesterday's action would call a test of resistance. And today, by virtue of us being below the low of our high day in the bounce, a lot of traders would suggest that we are right back on that bearish trend. And so there's not a lot of difference here as it relates to the NDX versus the SPX, is there, everyone? We see a lot of similarities. So what we now have is the initial break, a throwback to resistance, and a reversal. So what's next, everybody? A lot of traders will suggest that now risk needs to be at least managed to the last low, right? Because again, we can make a matching low and get a bounce. Well, the matching low is right around here, 22,850, which is about 700 points away from where we are right now. But the measured move low would be down here around 21,500 or so. And that's the distance from our height, the peaks, to the neckline. And then because the neckline broke, we could approximate the measured move like so. So I hope you saw what I did there, everybody. I just duplicated my line, measuring the peaks to the neckline, took that line and put it over here to the far right so that we could approximate where the measured move would go. And of course, that's just an approximation, right? We cannot use that as a means of saying, well, then clearly we're going to hold up any selling at 21,500. There's no way it can go lower than that. You all know that's not right. Of course we can go lower than that. That is simply a guideline for bearish traders for consideration. If it stopped there and then we held that level for 4 sessions, 5 sessions, 6, etc., and just kind of meandered sideways, that might give traders reason to believe that that level can hold, but it's going to be one of those wait and sees as we get there. Okay, Rita, great point. I'm glad you mentioned it, not because it's the Horner rule, but again, the reminder that we must define confirmation. So yes, yesterday, if you were prepared for the bounce and you said, well, I know we're in a bearish downtrend, right? We've been failing at the 20-day, barely making it to the 50-day. We are trading below the 20, the 50, and the 200. I've got plenty of reasons to not necessarily believe that this bounce can be maintained. And if that was your the bias you had yesterday, well, then you were provided reasons to be definitive. That is to say, not buying into this, because one day back above the resistance does not necessarily reverse a trend, does it? And Rita's pointing out the so-called Horner rule, which just says define your level of confirmation. Is one day above resistance enough for confirmation. Today, clearly not, at least not in this market, right? So if you were waiting for 2 days or 3 consecutive days, good, because you didn't buy in based on yesterday's candle, right? You probably said, all right, I need to see more evidence. That's forcing the market to give you what you need to validate and verify that there is a different trend. And by forcing the market to do that, by defining your tolerance and comfort as it relates to your confirmation, well, you've given yourself a leg at least up on those that believe that one day above a resistance band was enough, right? It could have been, it just didn't play out that way. Okay. So as always, know what it is that you will use to define that confirmation for you. And if you have that bias, it's okay to be biased to a certain extent, but make sure that you have more. As important as your bias is to have the plan, how will you adjust your positions, take advantage of what you're seeing, either use that bounce to reduce position size as opposed to adding risk, right? So let's take that to heart, and we'll continue to utilize that in this class in particular. I'll continue to mention the importance of defining our levels of confirmation. What is it we want to see? Okay, so there's your big two, everybody, the S&P 500, the NASDAQ 100. We've talked a little bit about the relative outperformance with the Russell, but it's been exactly that, relative outperformance, but by no means substantially better. We did get above the 20-day yesterday, but that looks like a dragonfly doji, a beautiful candle at one point yesterday that just didn't hold. And so where are we? Back below it. Again, a close below the low of the high day, or at least to this point today, a trade below the low of the high day. We're hoping to see more confirmation of the 200-day moving average as support. 1 day closing below it does not break the trend. So there you go. There's a Horner rule conversation around that 1 day low. What we're ultimately looking at here is, can we just kind of meander into the 200 and hold? So that remains to be seen. Now, yields today are bouncing a little bit. We found support with the lows in this pullback. So if we continue to see selling of U.S. Treasuries, particularly as it relates to the 10-year note, then we're going to see a rally here continue, perhaps. This is important for us relative to what's going on in the Russell, of course, so we'll monitor this. Additionally, the selling of U.S. Treasuries does have impact on the U.S. dollar, and we'll take a quick look at the dollar, which did find support yesterday. So where we were having an opportunity from the U.S. dollar side with the dollar retreating, well, all we did was retreat to the 20-day, an area of short-run support. And I can even put in a horizontal trend line, support line rather, right through these recent lows. So you can see this has been kind of resistance, support all of a sudden. And then today you're getting a pretty good bounce in the US dollar. So again, remember, stronger dollar, more difficult on your multinationals, your larger companies, right, that do business globally here. This is not a wonderful development. In fact, the throwback to the trend line and hold of the trend line seems to imply for bulls, at least as it relates to the US dollar bulls, more upside in the US dollar, which could mean more headwinds toward the US markets. So keep an eye on the dollar moving to new highs. Over this ledge here, basically moving and making new highs in the short term. That would be a significant headwind on broader U.S. markets. So just a heads up. Okay, let us look at the semiconductors. I said yesterday, we get these big snaps, everybody, and boy, do we. We get significant moves in terms of percentage, even as we are pulling back. So we've had a good sell down from our extended peak to the low we made early on Monday, right? And that move was about 16.5%. Well, the bounce, about 17%. The bounce from that low to yesterday's peak was 11% in 2 days, everybody. So again, it's easy percentage-wise, you look at those numbers and you say, man, this is great, an 11% bounce. Clearly, everything's good, but that's obviously not the case. The broader trend needs to be noted. We got to make note of the fact that we are still below the 50-day. And when you look at the structure up here, everybody, we did it yesterday. We called out tails, 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 all in and around the 50-day. All of these tails tell us something, don't they? That tells us that we've gotten into that ledge before and bulls were overtaken by the selling pressure up there. Lots and lots of selling pressure in that vicinity. So knowing that, we should not be expected to find price in that area. What we should be shocked by would be prices in this area that then carry higher, closes over this vicinity, right? And there's a pretty wide range for monitoring here, but you can see that basically all of this, save for one close there and one small close here, all of this is price action of, that was intraday in nature, right? We did not get through it on a closing basis, and therefore you got no trend change, right? And lack of trend change means more of the same, unfortunately. If you were looking for some tertiary detail to kind of validate that bearish opinion, well, your RSI has been validating the lower highs as well. So our bounces have been on lower levels and bearish, as our friend Rachel calls it, the bearish regime. Ultimately, it's just the action of the RSI. Remember, we get overbought conditions over the 70 line in the RSI. And when we are in a bearish, broader sense, then our overbought conditions will commonly come into play around 50 to 55. And if I put a line at the highest high we've made in the RSI, look at what it happens to be over on the far right, everybody. It's 53.5 approximately. So you know that we've seen a weaker market in the SOX and the semiconductors, and our RSI is validating that bearish sense because rallies into the mid-level, the 50 to 55 zone, have been overbought conditions that have seen prices retreat. Okay, so hopefully we have been able to, if nothing else, have traders understand some important levels where you can manage your own risk. Again, we don't know the next move. We do know that if we get back above the 50-day, well, then we can change our tolerance for risk a little bit. We could probably feel a little more comfortable. If we took out this low here, once more, 7,300, well, then we probably need to be a little more defensive in nature. Or I should say, traders with your money on the table, you need to be a bit more comfortable with what you have deployed. If you're looking at the balances and saying, I need to expect weakness, can I stick with my positions? And your answer is no, well, then the action needs to be reduce position size, build cash, sit more comfortably, let the market do what it's going to do, and then look for your chances to redeploy. Okay? Always be confident in managing your comfort for risk. I know that it stinks, but you have to think about your worst case scenario 100% of the time. Otherwise, we put ourselves at a greater level of risk than we have comfort for, and you may find yourself stuck in positions for longer than you have comfort for. All right? So, okay, Wacky. I mean, listen, I love Steve Miller, but you're going to have to at least give me the quote that he said. Which one are we talking about? Fly like an eagle, or the one that am I a picker, a grinner, a lover, a sinner? Yeah, definitely. I just want to know which one you're referring to, Wacky. So follow through. Give me your quote. Okay. All right. So we've seen the S&P, the NASDAQ, the Russell, the semis. Let's go ahead and hit up the transports. We're going to look at our components here as well. So here we are, everybody. Transports bounced off of horizontal support. Okay, take the money and run. I should have known better. Thank you. Thank you, Wacky. Yes, that's perfect. I don't know why that one didn't pop in my head immediately. Apparently the coffee hasn't hit. Good call. Good call. Okay. Transports. Why is transports interesting? Well, obviously pressure tied to oil is going to weigh heavily on this group. Now, the level we bounced off, let's go back to my weekly. My line on the daily is green, but ultimately it's the same white line, right? And remember, this was an all-time high that we cleared, we rallied, got thrown back, and have held. So now we are sitting here at the 20-week upsloping moving average providing support. That's notable, but in the shorter term, as is the level to which we rallied. Let's look at this from a standpoint of technical analysis conversation stuff, right? Technical analysis 101. What did we do? Well, Kev, why did you put that line there in the first place? Well, the biggest reason, it was a gap. We had a gap move from the 5th to the 6th. We gapped aggressively down. So what does a gap give us? It absolutely gives us a level to which we can see rallies lose steam. There is a ledge of resistance at the gap zone, and that's exactly what happened. Yesterday's finish through the 50-day moving average, even the intraday high into the gap, couldn't hold it. Now, we have traded below yesterday's low, but it has not held, right? So you're getting a little bit of a lift there. That's a little interesting to me. And doesn't necessarily mean that everything's okay, but it bears watching. I'm interested that this is only down 1% today, while oil is up 13%, at least relative to the time frames we were looking at there. Now, let's take a look at the component groups here. So let's see how our rail stocks reacting. Kind of similar, right? Let me go back. Let's put up the 200. Okay, so we've got we're still in the channel on the rail stocks, higher lows along the way. Okay, bounced here from the channel and moved off of it. Put them all back in there. And so, we're still basically, I think the channel is the level that a lot of traders are monitoring in here. Going back to the lows of last April, okay, you've just basically seen an uptrend. Yeah, we got above it, got a little exuberant up here, and then we got thrown back to the bottom of the channel. So it looks like the channel is the most important area for monitoring here. And the channel bottoms do coincide with the 200-day moving average. That'll give you something to maybe keep an eye on with regard to the rail stocks. Now let's look at our trucks. So the truckers are going to be a bit more volatile, it seems. Now they are back above the 50-day. This kind of is a bit notable since, look, I mean, let's see, we held this. We got the 20-day down sloping, but everybody, look, we're back above the 50-day. This is day 3 above the 50-day. This bears watching. This is notable because this is not what I would have expected, especially with higher oil on trucks. So keep an eye on that one. And again, your truckers, those are companies like, just some symbols here because I can't show you much more, but let's look at like Old Dominion, for example, is one of them, right? There's one trucker. JB Hunt, another trucker. That looks kind of similar to the whole transports situation. ASEA is another one, okay? So you've got some ideas, but these are companies, again, look for things that are different, that are, as somebody said, bucking the trend. Yeah, that's interesting to find those where you can. Now, the other area, of course, within transports, let's look at our airlines. So there's the airlines. I've drawn in a bear flag breakdown continuation pattern, basically a bear flag target if it were to break down as such. Let's lift these lines. Okay, so we did break the bear flag, but now it seems to have kind of devolved into more of a new trend, right? A new kind of like this, just a new short-term channel. And it still could be, this is still bearish in nature because we do remain below the 200-day moving average. And again, notice all the tails there. We're going to look at some stocks here. Well, at least one stock in this space that was adjusted. I thought I had a story on it, but I'm going to have to find that for you. Okay, so there's your transports. And then I wanted to bring back Rachel's charts on relative strength. So here's your visual in terms of leadership versus the S&P, everyone. Notice how some of these are really standing out. Utilities, This is a notable trend, right? Pretty aggressive uptrend there. Real estate is still outperforming, kind of far better than you would have expected. The technology look at things is intriguing because we've got that 3 lows in a row that have all maintained. This is not terrible. This is actually looking a little bit interesting. Let's see if this maintains. We'll have to take a look at this over the course of a couple more weeks, but you can see lows have been well established here from a relative strength standpoint. If those lows are maintained, well, then we could expect technology to get a little bit of a lift here near run. See the difference there? Look at discretionary. Discretionary making a kind of a pattern of lower highs. That kind of stands out, right? So that's not wonderful. But look at what energy is doing. I mean, goodness, just clear and obvious outperformance. And further, you're getting something just not as exuberant in the way of outperformance with Staples. But notice here, Staples well outperforming and then a little bit of a consolidation of late. So this chart or this grid, yeah, we can share this grid, everybody. I think this is automatically shared in my show notes. So if you're getting this class in the archive, just double check down below for the for the relative strength grid in the show notes. All right, here's the relative strength grid in the chat, everybody. Feel free to save and load that up and save it for yourself. And then, of course, this is the visual of everything, but you all know that we've got access to the same stuff just from the numbers basis. And we take a look at, year to date, energy up 2.3 today, but still 35% year to date. Materials doing pretty well, up 10% year to date. We will look at materials momentarily. I wanted to highlight, yesterday, actually on Tuesday afternoon, it was in my building a stock portfolio class, everyone. One of the things we were looking at was taking advantage of the brief drawdown in energy to look for opportunities in that space. And look at what I had drawn in was this move back to early December where energy had established its floor. And then we've had this fantastic rally, the 20-day moving average upsloping in orange here. Yesterday's lows hit the 20-day, traded through it, and the 20-day is coincident with the 23.6% retracement of that entire bullish move. So you've had a fantastic rally, a brief pullback to the area of short-term support that has maintained for a lot. I mean, we're going back to December 23rd here, everybody. So you're looking approximate. Well, I mean, if let's just do it just from the 29th, since we were clearly above it, and then we take today into account, and you're looking at 66 bars in a row, 66 sessions in a row, holding the 20-day moving average. That's tremendous. At some point, that's going to change, but it hasn't yet. And so when we were talking about it in the class on Tuesday, the conversation was around using the drawdown to find equities in the space that have participated in a pullback and could be near support. And that would be an intriguing area, an intriguing way to kind of join the existing trend. Remember, it's hard after 3 red days to look at a pullback and say, perfect, that's what I was waiting for, because that's not human nature to double check the red candles and be like, well, I found support. I should be ready to buy here. But it's not that easy, as always. I mean, we hope it is. That's why we talk about it so frequently. Buying near support is what we want to be doing. Buyers near support, not sellers near support. So if we were able to expose new money to energy just yesterday near the lows, well, we've had a pretty decent move and bounce. And now, if nothing else, we know that assuming we hold the 20-day now, we've got continuation as our opportunity. A close below the 20-day could bring us back to an area of potential horizontal support, and that would happen to maybe coincide with the 50-day. So some traders might be looking in this zone as well. And there's nothing to say that we even have to get down that far. Even if we did break the 20-day, we could easily hold up somewhere in between. Okay, but the reminder is bullish trends, when they're breathing, if you want to stick, if you're looking to join into those trends, the time to be buyers is when they throw you back to areas of short-term support so that your entrance is at what you would consider a lower risk zone, right? So that's an excellent development if you're heavy into energy. You like what you've seen there. Now let's look at materials, and then we'll check out our precious metals. Materials have rallied back. This is an interesting spot. That white line might be too fine. We'll put it with a rectangle. Here's the gap, kind of in this zone. And so, yeah, we've traded below the low today of the high day. So yesterday being our high day, a fantastic move. Let's see how that candle finishes. This is trying to hold in there, trying to let you know that everything's fine in materials. But where are we going to feel better about materials, everybody? It's back over the 50-day. Now let's take a peek at the future symbols on silver and gold. We'll start with gold. Remember, these are just the symbols. We're not certainly not encouraging futures trading. What we are doing is trying to get comfort with the trend in gold. The bounce happened to nail the 200-day on the money back here about a week and a half ago. And where did we currently pause? Right at the 20-day. The 20-day was support for a good portion of this. Now we've got a nice little bounce. Now, timing matters. The length of your trade, the length you would like to stay with something matters. If you're a daily chartist, you're going to see that there's still some volatility here in gold. If we go back to the weekly, though, this chart looks a little different, doesn't it? It looks a little bit more confirmed to the trend. You've got a wonderful run against this 20-week simple moving average, the 50-week simple moving average. Low last week kind of happens to be right there. So if you're the individual who's long gold, wants to stay long gold for an extended period, thinking months and years, if not longer, well, then potentially the time to make a change to that trend or a change to that concept becomes when we take out the 50-week moving average. And mainly because we are so far away. Notice how this is getting further and further from the 200-day, right? So you've got this is a widening move, isn't it? Right? You've got big moves and bigger, and it just gets wider and wider. So eventually, when we take out the 50-day moving average, we're going to potentially see a bigger move to the downside, a bigger swing. And we've already witnessed pretty good swings here, everybody. So just keep that in mind when you're thinking about the longer range trend, the significance of the major moving average providing support changes with prices beneath it. But the big difference here is the further we go in the upside move, the bigger the reversal becomes, right? So I hope this is a key point. And this is also what we've seen in silver. The move in silver was a bit more aggressive to the upside, a bit more of a FOMO, right? Go back to just January, or the close on December 31 here. The close was 70, just shy of 70, 90, 71. So let's just put it right there and draw to the peak just to illustrate the speed of a move. This was a 72% pop over 4 weeks, everybody. In a month, silver rallied 70%. We shouldn't be surprised to see silver thereafter sell down 48%. Okay, that's a big swings. Now, looking at silver on the daily, we see a lot of the same stuff, lower highs, failing now at the 20-day, 200-day providing potential support beneath us. Longer term, looking kind of similar to what we saw in gold. But again, look at the differences between the moving averages, everybody. They just continue to peel away from each other. Maybe the 50-day is the near-term support here. There you go. But if not the 50, then goodness, you've got pretty good move. If we were to expect the 200 week to provide support, that would be less than wonderful if you were long silver at this point, right? Because that's not what you're looking for. It's not a move from the 50 down to the 200. That would be rough. So let's make sure we don't find ourselves in such a scenario, right? Especially if you've been trading it all the while and you're sitting on profits. The last thing we want to do is turn a profitable trade into a losing trade. So make sure you're paying attention to the levels that make sense to you and your comfort more so than anything else. And then we should also look, and I know it's not a true material, obviously, but we're going to check in on Bitcoin. Crypto, yeah, it's a future, but it's also crypto, which means it's more risky. We know it's not backed by anything. The trend here is a little bit notable as well. We have my line at the extended intraday low, but I'm going to raise that up. I think that it might make sense to push that a little bit higher so that we traders can kind of get an idea of. You are all fantastic for your patience, everyone. I'm very sorry to be experiencing this audio/video hit. Apparently, my Wi-Fi has really taken the week off already. So you know what? We're going to go ahead and wrap it up there. I did want to mention more, but I'm already lost in it kind of at times. So listen, more to come from us as we round out the final trading day of the week here ahead of the Easter weekend. So reminder that tomorrow is a closed market day. We will return for you live on Monday of next week. I will certainly be here for Monday's Trader Talk. And I want to further reiterate that we're here to lend a hand where we can. Don't forget to come out to the events to meet us, everybody. You know, we are going to be out in Dallas here coming up. I wanted to remind you all of that. Yeah, Dallas for the Advanced Options Workshop coming up just a couple of weeks out. And actually, a week from today, I'll be leaving to go to Dallas. We'll be in Boston the week after. And then if you've gone to the Chicago workshops, but you haven't had an opportunity to attend the market drives yet, these are an excellent way just to get a little picture into what the market's doing, but also what is the Schwab Center for Financial Research finding in regard to the market, our current trends, what are they worried about, what are they thinking about, and what do they believe the broad market could bring us between now and the end of the year. So market drives a little bit different than your standard workshop. It's only a one-day event, but a good event nonetheless, and we anticipate having quite a few of you joining us for the market drive. And if you've not been there, I'd love to see you. So for those of you that are coming to any of these events, make sure you stop by, say hi, let me know that you attend the classes, get a hand, shake a hand, and I'd love to see you, take a picture, whatever you want to do, just stop by and say hi, let's have a chat. I'd love to see you all there. So Barb, thanks for managing the chat today for me, and thanks for managing all of your expectations with my struggle here on Wi-Fi. I apologize, but looks, of course, inevitably now that we're at the close of the class, everything's perfect. So this is usually the way it works. You all are great. I really appreciate you joining me today. Make sure you're following Barb and me on X, Barb Armstrong CS, Kevin Horner CS, and hit that thumbs up button for me down below. I'm going to get these notes into the archive for you as quickly as possible, and that'll help us out on the replay. So with that, have a fantastic weekend, everybody, and let's meet up on Monday of next week. We'll do this all again. So stay well. Happy Easter. I look forward to seeing you again soon.